Hello friends, this is Hatim Rampurawala, and in this video we would be revising IND AS2, that is inventories, and in this video we would be doing a few or some of the illustrations of IND AS2. Okay, not we would not be solving all, but yeah, we would be doing few of them. If you need any of them to be solved, if I had skipped that, you can comment it in the comment section below. So let's start. Illustration 1. As per India's 2, inventory includes the as per India's 2, inventory includes the material and the supplies awaiting use in the production process, whether the packing material and the publicity material. So whether the packing material and the publicity material are covered by the term material and are covered by the term material and supplies awaiting use in the production process. Solution. While the primary passive, see, if it is a primary packing, it will be included. And if it is a secondary packing, it won't be. That is, while the primary packing material may be included within the scope of the term material and the supplies awaiting for the use in the production process, but the secondary packing material and the publicity material cannot be so included. So cannot be so included, as these are the selling cost which are required to be excluded as per Ind AS 2. So publicity material or secondary packing cannot be included, but primary packing will be included in the cost of the material, because the secondary packing or the publicity are the selling cost which are need to be excluded as per Ind AS 2. For these purpose, the primary packing is the one which is essential to bring the item of an inventory to its sellable condition. So the primary packing is the which has need to bring the item to its sellable condition. For example, bottle, cans. In case of foods and beverages industry, other packing material required for the transportation and forwarding the material will normally be in the nature of the will normally be see other packing material like transportation and forwarding packing material will normally be in the nature of the secondary packing material. Okay, so other packing so what we had concluded is, if it is primary, so it will be added and secondary will not be added. Okay, we are done with this. Now we'll move on to illustration number 2. See, it is question based on what all will be included in the cost of the inventory. Venus Trading Company purchases the car from the several countries and sell them to the Asian countries during the current year. These company had incurred the following expenses: trade discount on purchases. So trade discount will be deducted from the in cost of inventory. Handling cost relating to the import, it will be added to the cost. Salary and accounting department will be excluded. Sales commission paid to sales agent excluded. Other after sale warranty cost excluded. Import duties will be included. Cost of purchase based on the supplier invoice will be included in the cost. Then freight expenses will also be included. Insurance of purchase will be included. Brokerage commission paid to intending agent will brokerage commission will not intending agent. See, this brokerage is not the secondary not for sales commission brokerage, but it is paid for bringing the goods to the present location. So this brokerage commission paid to the intending agent will be included in the cost. Evaluate which of the cost are to be allowed as per Ind AS 2 for the inclusion in the cost of the inventory in the books of accounts of Venus. So we are done with this. Then we'll solve illustration 6. See, whether the entity can use the different cost formula for the inventories held at the different location. So what the question is stating, that whether company can use different cost formulas, different cost formula for the different for the inventories which are held at the different geographical location, having similar nature and the use and similar nature and use. So what the conclusion is, no different cost formula to be used for the item for the inventory having the similar nature and the use. So we have to value, that is, we have to apply the cost formula on the basis that on that is if the nature and the use of the nature of the use of this and inventory is similar, then whether it is located in different geographical location also, then also it will then also the same cost formula to be we have to use. See, we'll go through the go through the answer. That is para 25 of Ind AS 2 prescribes that the cost of the inventory other than the item of the inventory which are not cost of the inventory other than the item which are not ordinarily interchangeable, uh, so means which are not frequent, not ordinarily interchangeable, shall be assigned to the first in first out or the weighted average. An entity shall use the same cost formula. So the entity has to use the same cost formula for all the inventories having the similar nature and the use to it. So for all the similar nature of the inventories, entity has to use the same cost formula. In this case, since the inventory held at the different geographical location are different, are of the similar nature. See, whether if they are even if they are located at the different geographical location, their nature and use to the entity is similar. So the different cost formula cannot be used for inventory valuation purpose. So different cost formula cannot be used. Okay, so we are done. Then illustration 7. Mercy Limited uses the periodic inventory system. The following information relates to 1 2. It uses the periodic inventory system. So for April, May, September, detail has been given. Inventory units, cost per unit, total cost. So April 200 units, May 50 units, September this much. This all is the purchase. In February also there is a purchase of 350 units. Now physical inventory as on 31st March 2002 is 400 units. Calculate the ending inventory and the cost of the sale. So we have to calculate the ending inventory, that is closing value of the inventory, and the cost of the sale using the FIFO and weighted average. So it is much simple. See, we have to calculate for 400 units. So if we go it by FIFO method, so the cost will be 350 into 14, and the remaining 50 will be from this September purchase, that is for 50 into 12. So we'll get the total cost after multiplying 5500. Okay, this is the cost. And how to calculate it is the cost, that is it is the closing stock. And how to calculate the cost of sale, that is the total cost is 12,250. Of that the closing stock is 5,500, so balance is sold, so that becomes the cost of the sale. Similarly, in case of weighted average, what we'll do is the total of 12,250 will divide by 1,000 inventory. So per unit we will get 12.5 that we will multiply by 400, so we'll get 4,900. And how to calculate cost of sales is 12,250 minus 4,900, that is 7,350 will be the 7,350 will be the cost of sales as per weighted average. So we are done with illustration. We will do the texture knowledge part as well. Okay, so UA Limited purchases the raw material for 400 per kg. The company does not sells the raw material but uses in production of the finished goods. The finished goods in which the raw material is used are expected to be sold at a below cost at the end of the year. The company is having 1000 kg of raw material in the inventory. The company never sells the raw material. It does not know the selling price. See, it does not sell the raw material. It does not know the selling price of the raw material, and hence cannot calculate the realizable value of the it cannot calculate the realizable value of the raw material for valuation of the inventory at the end of the year. However, the replacement cost of the raw material is 300 per kg. Replacement cost is 300 per kg. How will you value the inventory of raw material? Simple. We'll calculate as 10,000 kg into 300 per kg, and not the purchase cost of 4,400 per kg. So India's to inventory, we have to calculate at a cost on net realizable value, whichever is lower. So cost was 400, net realizable value was 300, whichever is lower, so 300. As per India's to material and the other supplies held for use in the production of the inventory. And see, Ind AS 2 inventory material and the other supplies held for use in the production of the inventories are not written down below the cost if the finished product in which they are to be in which they will be incorporated are expected to be sold at or above the cost. If they are expected or to be sold at or above the cost, see, it will the cost of the material will return down. See, the written down value what they have given is that the inventory, the material and the other supplies held for use in the production process of an inventory are not written down below the cost if the inventory, see, the material, raw material will not be written down below the cost on what we had purchased from of what at what cost we had purchased. It will not be valued below the cost if the finished product which has been manufactured incorporated from that are expected to be sold at above the cost. However, when these are when there has been a decline in the price of the material, and it is estimated that the cost of the finished goods will exceed the net realizable value, will exceed the net realizable fixed cost will exceed the net realizable value, that is that is the selling price will be less than the cost, the material are written down. And if it is not sell at above the cost but it is sell at a lower price than cost, finished goods are sell at lower price than cost. So basically we have to apply that reduction in the cost to in raw material as well. Hence the material are written down to the net realizable value, and it will not be maintained at cost but will be written down to net realizable value. In such a circumstances, the replacement cost of the material may be replacement cost of the material may be the best available measure of the net realizable value. Therefore, in such a cases, UAL Limited will value the inventory of raw material at 30 lakh rupees, that is 1000 kg into 30 per kg. Okay, and we are not doing the second test and knowledge, that is manageable. So we are ending our video. Thanks for watching the video.